Warren Buffett is the godfather of modern-day investing and the voice of calm in turbulent markets. When Buffett speaks, the investing world listens.
Stick around long enough, you'll see everything in markets.
For 5 decades, Buffett has run Berkshire Hathaway, which owns 65 companies like Geico and Dairy Queen, plus minority stakes in Apple, Coca-Cola, and many others. His eye for investing and the voice of reason is something sought after by retail investors both old and new.
We faced tougher problems, and the American miracle, the American magic, has always prevailed.
Even during a worldwide pandemic, Buffett has preached a calm approach to the stock market by seeking value and not trading on fear.
Fear is something I really never felt financially, but I don't think Charlie's felt it either. But some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time.
We're looking forward to covering the big event on May 1st. Coverage starts at 12:30 p.m. Eastern. Moomoo is our title sponsor. I'm Andy Serwer, Editor-in-Chief of Yahoo Finance, and thank you for joining us for this special preview of the Berkshire Hathaway Annual Shareholders Meeting. Before I bring in our all-star panel, let's take a quick poll on our Blue Jeans platform. Question: are you a Berkshire Hathaway shareholder? And if you are, let us know if you own Class A or Class B shares. Use the right-hand side of your screen to respond to this anonymous poll. We're just looking at these numbers numerically. All right, so let's kick off this great panel. We have some of the world's greatest Buffettologists or Berkshireologists, depending on what you want to call them, joining us today. Lawrence Cunningham from George Washington University, Tom Gayner, co-CEO of Markel, Robert Hagstrom, author of The Warren Buffett Way, Investment Strategies of the World's Greatest Investor, and distinguished financial journalist Carol Loomis. All of our experts have followed Warren Buffett for many years, and welcome to you guys all. Thank you so much for joining.
Good to be with you, Andy.
So why don't we start off by going around the horn, and I can ask you what the Berkshire Hathaway annual meeting means, why it matters for the investment world and for maybe each one of you personally. And Carol, I want to start out with you, and I know it's kind of an open-ended question, but I know you've got some great thinking here.
Well, Andy, first of all, I haven't missed the annual meeting in years now. It's a great convivial event in which people who have learned to know each other over the years reconvene. It's terrific. And you have two of the smartest guys in the world sitting up there ready to answer any question you ask. I must say that they are pretty good about meeting them straight on. And the great thing that's going to be happening this year is that Charlie Munger is back. And everybody knows that as a twosome, either one of them would be great, but as a twosome, they're even greater. And I have learned myself so many things at that Berkshire meeting. And I relish the chance to get back at a real one, but it's going to be wonderful to be seeing it this week as we get together once again.
That's great, Carol. I think, all of us will looking forward to next year already, but we have this year very much to do as well. And, it is great to have those two guys reunited. I talked to Buffett a little bit a few weeks ago, and he was just so excited to have the opportunity to be back with Charlie. Tom, what about you? What do you think is so important about this Berkshire Hathaway annual meeting?
One of the ways to describe it is I would say it's the greatest convention in the world for people who are investment oriented in the particular sort of tribe of Berkshire-like thinking that Buffett and Munger have done over the years. So it is an absolute link in the chain of my life to think about the relationships that have formed with people that I've met through the Berkshire meeting itself. And I have Carol to thank for the initial introduction and explanation of Berkshire Hathaway, because I read her articles back in Fortune magazine. I think it was 1984, and I will say I was 23 years old at the time, and I was working at a small brokerage firm in Richmond, Virginia. And I read that article, and the scales literally fell from my eyes in terms of how to think. And I went into the guy that I worked for that was a bit of a crusty older gentleman, and I said, "Hey, have you ever heard of this guy Warren Buffett?" And he said, "It's Buffett, you idiot." Threw me out of his office. But that was a pretty good breadcrumb to pick up and start. And when I joined Markel in 1990, I told Steve Markel the people who are most likely to understand what we're trying to do are people who already own Berkshire. So rather than us trying to get people to come to Richmond, let's you and I go to Omaha and start meeting people. And that very first year, which was in 1991, we bought coffee and bagels for 6 people. And every year we continued to return and have had a very important event for Markel out there over the years. And the year before last, the last time we were able to hold it live, it was 12 or 1,300 people. I would say a majority of the Markel stock that is held it was in that room at that time. Probably more shares of Markel than would be at our annual meeting. And from a personal basis as well as a professional basis, some of the best friends I have in the world are people I've met through the Omaha process. And I miss it terribly, and I look forward to returning as soon as possible.
Thank you, Tom. Larry, I want to go over to you. And first of all, thank you very much for having the idea to do this webinar. This is your baby. So kudos to you for getting this all together here. So top line, what is it about the Berkshire Hathaway annual meeting that sort of strikes you the most?
Well, thanks for partnering with us, Andy, and thanks to the panel and the audience. It's a really a wonderful opportunity to do something that we usually do in Omaha, but this year we have to do it in a webinar. The meeting is a central part of Berkshire culture. Warren set out 50 years ago to attract a certain shareholder base, a group of people who would focus on the business, not the stock market, focus on long-term, not short-term, and focus on Berkshire and not some wide index. And attracting that group of shareholders to the meeting is a catechism almost. It's a playbook, as Tom was saying, that like-minded people who want to own a business, a piece of a business, want to own it for a long time, gather and share views about investing and business. And it's forged a certain culture at Berkshire Hathaway. So Warren succeeded in that, and I think it's a wonderful tradition. It's preceded by his annual letter, which is an equal important part of the culture. Virtually everyone has read that letter beforehand and come to gather the first weekend in May to discuss it. So it's been a central part of Warren's accomplishment.
Thanks a lot, Larry. And Robert, I want to go over to you. We actually have 3 people on this call, I believe, who've written books about Buffett. And yours may be one of the most famous, I guess, which is The Warren Buffett Way. 1 million copies in print, maybe more than that, translated into, I forgot how many languages you all told me before. It was like maybe 15 or something like that. Really amazing. So for someone who studied Warren Buffett so deeply, what about you? What's your take?
Well, I think, I'm kind of like Tom. I came into the Berkshire Hathaway culture, introduction to Warren Buffett by being a student. I was a broker in Baltimore, Maryland. Part of our training class was to read the Berkshire Hathaway annual report. And like Tom, it was the proverbial light bulb went on. Everything just started to make sense. And since that time, I think, the best description of how I approach Berkshire is I'm a student. I'm still learning. I'm 65 years old, and I'm still learning things today that I didn't know 5 and 10 years ago. So my relationship to Berkshire Hathaway, and Warren Buffett is really a university student who wants to come to Omaha every year, take as many classes, meet as many people as I possibly can, have as many conversations. They're all smart. And every time I leave Omaha at that first week of May, I'm much smarter than I was before I got there. I can agree.
The question is, and we were talking about this a little bit before we turned on the cameras, that these lessons seem so simple, and what Robert, you're talking about, you got it in your brain, you got it, and then you leave and we forget them. So I know this idea of being reinforced is an important one. I want to go back to the polls here because we've just closed the first poll about who's on the line, which is pretty interesting. So we've got 14% of those answering are Class A shareholders, 68% own Class B shares, and 18% don't own any Berkshire Hathaway at all. And maybe those people are maybe listening most intently because maybe they intend to or are thinking about it. So that's pretty interesting. Before we get back to the panel, I want to ask, put out another poll, and this is about the meeting itself for those of you all who've been there. During the Q&A, which part of the meeting seems most important or best to you? Buffett's introductory remarks, his answers to questions panelists ask, his answers to questions live shareholders ask, or, and I got a favorite here, I have a favorite here, Charlie Munger's comments. Again, the polls are at the bottom right-hand tab on your screen, and you can also send us your own questions there. Importantly, we'll be taking some of those as well. So, we talked a little bit about the annual meeting and the company and just how different the company is. And there really is certainly no other annual meeting like it on the planet. I think that's very safe to say. The culture is very different. The shareholder base is very different. And I guess I want to go back to the panel picking off that point, which is, what makes Berkshire Hathaway so distinctive? Is it a model that other companies can copy or learn from? And if so, why don't they do that? And Larry, why don't I start that one with you?
Yeah, sure. Berkshire is distinctive in a lot of ways, and there are some other companies that try to emulate at least parts of it that work for them, and many of them do it quite successfully. The distinctive parts start with the idea that the company is a partnership. That Warren is not sitting at the top of some empire calling the shots and increasing his power over everyone else. Every stockholder shares in lockstep. He thinks of himself as a general partner of a partnership who is trying to make the best decisions for the company as a whole. The company is also highly decentralized. That is, Warren is not directing the managers in every aspect of their business. Berkshire acquires the business, ideally with good management in place, and then defers to those managers to execute on their own strategy, leaving them alone in a trust-based environment, which is very distinctive in corporate America, which tends to prefer a lot of directives from headquarters, a lot of internal controls and training and reporting. And the Berkshire magic is that the trust-based culture actually delivers better performance than the control-based culture. It's contrary to conventional thinking and practice in corporate America. And that filters out into every other aspect of the business too, including the shareholder relationship, the way the board operates, and even this meeting. It's a real trust-based culture. The dozens of other companies that have emulated it include the company that Tom Gayner runs. So he'll be a good one to talk to. But I've studied Markel. I've studied these companies, and there are a couple dozen, and they tend to do as well in outperforming as Berkshire does. So it is an interesting question. Why don't more companies follow the Berkshire model or parts of it? And one of them is just there's overwhelming pressure to conform to the centralized, control-based model, to concentrate only in a certain industry rather than being a little more broad-minded. There's just overwhelming pressure for short-term results, for quarterly guidance. And so Buffett and Berkshire have been able to withstand that pressure, and so has Markel and the other companies. I'm glad you're putting some examples of companies that I've studied that follow this model. They're able to withstand the pressure. For one reason is because they perform, but the other is that they have a patient-focused shareholder base, and that's such an important part of this. And again, the annual meetings are an important factor in being able to achieve that.
Right. Yeah. And in fact, you're right, Larry. You can see those company names up there. And also, we had a previous slide up which showed sort of the organizational chart of Berkshire. And that was taken from one of your books. Thank you, Larry. Margin of Trust. Mentioned Robert's book, books, plural, because he has another one we're going to talk about in a minute. But Larry, you have a number of books as well, Margin of Trust, Berkshire Beyond Buffett, and then one I was looking at last night, the Warren Buffett Shareholder, which are essays by people who've attended the meetings. Super cool, interesting. Everyone's got their own story. Carol, I want to go over to you and ask you about what makes Berkshire distinctive. And I should point out Carol's book as well, Tap Dancing to Work. And Carol, I remember you working on that book when I was at Fortune with you a number of years ago. But talk to us a little bit about the what makes Berkshire so different and whether other companies can do what it does.
Well, I think that Warren Buffett and Charlie Munger make it different in the way they have actually run the company. Warren has been very fixed and not paying a dividend. That is a contentious matter with some people, but he has kept people with him, not paid a dividend, and therefore the value of the stock has built up. I think it's around $600 billion right now, and the company was literally nothing when Warren took it over, those many years ago. So I find the people who run it and the people they have hired, whom they have tried to keep coming with the same character, I find that is what is distinctive. And I was thinking, as someone was talking about something Warren said to me decades ago, he said, you only need to have one stock work out in your life. And this stock is something that has worked out for so many people, and they come and they remain dedicated to the company and are the kind of shareholder you want to have. So that's what I think is very distinctive, Andy. And I do want to mention that my book contains some stories, or one at least, that you wrote, so that it is distinguished by that.
Well, hardly, and I hope I didn't ruin the real estate values of the book with my stories, Carol. But
no,
thank you for including them. I want to go over to Robert and ask you to follow up maybe on what Carol just said, and because she mentioned the people, and boy, we all know that hiring people and bringing people on, picking the right people is maybe the toughest part of any manager's job. Do you think that is the point of differentiation, Robert?
Without question. I think if you were to, in my opinion, argue what is the greatest success, professional success, Warren has achieved, it certainly was building the culture at Berkshire Hathaway, bringing together owner, managers, employees, everyone, and they're all united, Andy, in one pursuit, the rational allocation of capital. I mean, that's what drives them each and every day. And when that works in concert with an organization as large as Berkshire, which is a conglomerate, and historically the greatest, most successful conglomerate in the world in history, you get a great case study on how to think about allocating capital. And it's top to bottom, from Warren all the way down to the last employee. That's what that's what the experience of Berkshire Hathaway is rational allocation of capital. That's the culture that Warren built at Berkshire, and that's the culture that will reside in Berkshire decades and decades from now.
Great. Thank you, Robert. Tom, over to you. Larry sort of gave you and your company a shout out and said you guys emulate, at least to a degree, what's going on at Berkshire Hathaway. Is that a fair characterization? And does that make it, tough shoes to fill, or high thing to aspire to then, right?
Well, I sure hope he's right about that. We do indeed try very hard. And I'll share one story. This goes back probably 15, 20 years. was an analyst who came through Richmond and visited Markel and listened to the story and what we were trying to do and what we were trying to accomplish, which the architecture and the structure is very similar to Berkshire. And we have indeed studied the playbook intensely and tried to learn from somebody who's been the very best at it. And at the end of his visit, he said, the trouble with you guys is you're trying to be just like Berkshire Hathaway. To which I responded, who would you rather us be like? So I thought it was a ridiculous question, but that's a true story, number one. And earlier you would also ask, why don't more people do this? Because that does seem to be a logical question when you see the success he's enjoyed in so many dimensions and the clarity of the writing and the communication, which makes it accessible to mortals like me. It would seem logical that more people would indeed try to follow many of the same points of view. And I think it's a complicated question that defies a simple answer. One of which is, Buffett and Munger are geniuses. Don't underestimate the raw horsepower and the cultivated intellect that they bring to the task at hand. So that's easy, much easier to say than do. But secondly, and I think this matters in today's world, there's a degree of personal responsibility that they have assumed in their management of Berkshire and their leadership. And they have a culture of stewardship and trust that they just operate with as they're managing money on behalf of other people. And when you do that, and you do it without skill or perhaps chinks in your confidence, sometimes that burden of responsibility can seem very high, and it can dissuade people from taking the singular type of responsibility that they've been willing to accept. And I just think people are very uncomfortable with this. I have a great friend, and I suspect many of you know him, Chad Rowe, who used to be a columnist himself, among other things. And Chad has distilled wisdom in spades. And one of the things Chad says is that in the investment arena, at any given point in time, you either look smarter or dumber than you really are. And people just can't stand that period of time when you look dumber than you really are. So it is personally challenging to accept that responsibility and endure the volatility and the periods of time when you look dumber than you really are, to get through to the longer term record. There's all kinds of structural impediments to doing that. Fortunately, when I showed up here, this was a family-oriented, family-owned company that had 3 generations of family ownership. And to Larry's point about cultivating the right kind of shareholders, who really had the mentality of trying to hand something off to the next generation that was better than what you got when you showed up. That just enabled us to adopt a longer-term way of thinking about things than many people feel like they're pressured into adopting.
Right. I love that, dumber than and smarter than the market. And I also love that comment about the person, the salesperson or whomever was visiting you and accusing you of being like Berkshire Hathaway. It's sort of like, well, gee, we're sorry. We tried to be like Madoff Securities, but we failed. What are you supposed to be like? That's incredible. Why don't we go to a little audience Q&A here? We've got one from John who's asked, how do you think Berkshire will evolve in the coming years? And Larry, why don't I hand that one off to you?
Yeah, I think it'll maintain its trajectory, or I should stress that they have done everything reasonably possible to assure the long-term success of Berkshire after Charlie and Warren leave the scene. They've identified excellent leaders who are on the board, who are running the companies. They've picked 2 from that cohort to serve as vice chair, one in charge of insurance, one in charge of businesses. They've got 2 extremely talented portfolio managers who understand investment selection and discipline. They have a loyal shareholder base who will probably stick with them at least for a considerable period of time. So I think that given the fact that there is Berkshire blood in all of these people, I think continuing to maintain the trust-based culture, the decentralized structure, capital allocation rationality, patience, discipline. I think Robert is right that we can expect Berkshire to endure for decades to come. I do think that it will require shareholder dedication. That is, during the 12 years after Warren passes on, his estate is going to transfer his Class A shares out through the Gates Foundation into Class B shares that will trade in the market. So we'll no longer have that bulwark, that 30% controlling shareholder, and it'll be up to the anonymous marketplace of Berkshire shareholders about whether they'll abide by the policy of not paying dividends and of not divesting underperforming companies. So the power will be in the shareholders. I've got confidence in the leadership, and I think that the shareholders will stay the course. And so I'm optimistic, but obviously no one has a crystal ball. But my bottom line is they've done everything reasonably possible to ensure the longevity.
Okay, you mentioned the AB shares there, Larry, and we have another question that sort of speaks to that. So I want to ask a question or pose a question that Darshan asked. And Carol, I'm going to give this to you because you're awfully good at explaining things. Ready? Okay. Why are there Berkshire A shares and Berkshire B shares? And can you buy fractional shares of Berkshire A? Well, that's B probably, but I'll let you explain that then. The difference between A and B shares.
Okay. Originally, there were only A shares. And then there were some people out there. I remember one of our managing editors at Fortune who had this, he said to me, why doesn't he split the stock? And then, in effect, this fellow at Fortune felt that he did split the stock when he created B shares, because it enabled people to take their A shares and convert them into the B shares that were sitting there, and the price was much lower. I think it's $200 a share-ish right now, and so this satisfied the wish of people to have a lower price stock to deal with. And Warren himself, much of his shares will move right away into B shares as they go down, as the years pass, and it's a highly contagious way in the market to have prices at stocks that are priced lower than what are we talking about now? 400,000 up, which is something some people just don't want to have to deal with.
Yeah, or can't deal with.
Right.
There is that. All right, let's look at the results of poll number 2. Maybe not surprising here, and this speaks to a point we're making earlier. So during the Berkshire Q&A, which part seem bets to you? Warren Buffett's introductory remarks, 15%. Buffett's answer to questions the panelists present, 25%. Buffett's answers to questions live shareholders ask, 18%. And maybe I led the audience here a little bit because I did say this was my favorite, but I think I'm not alone here because Munger's comments got 42% of the favorite. So not a majority, but a plurality of people preferred that over everything. And the reason I said this speaks to our conversation earlier, because we were talking about how much all of us missed having Charlie at the meeting. And Buffett himself, as I mentioned, really mentioned this to me, talked about missing Charlie. I guess, even when he says, I have nothing further to add, you guys, that is something that people get a big kick out of, because it's about the timing, isn't it? All right, let's do another poll here quickly, and then we'll get back to the conversation. Another poll. What aspect of Berkshire culture is most distinctive? Most distinctive. Your choices are trust-based, decentralized, autonomous managers' permanence. Oh, yeah, I see here. Okay. Trust-based decentralized autonomous managers, permanence long time horizon, or quality shareholders. I'm sorry, I didn't quite do that right, but you can see there's four. You have one of four choices there. Okay. All right. I want to go over to back to the conversation and Robert. And Robert, we've been talking about books and mentioned your biggie earlier, but you have a new one out just within the past, I think you said 4 months. And I'm going to hold it up right now. I'm going to see if you guys can see it. Let's see here. Right here. Oops, I got to tilt it down so we don't do the reflection. That's the producers always tell you that. And there it is. That's not Robert, by the way. That's Buffett. But Robert's name is right down there. And this book is called Warren Buffett Inside the Ultimate Money Mind. And this was something you had this kind of epiphany about the money mind. And I wonder if you could tell us a little bit about that.
Well, Andy, I appreciate the mention. The book's been out 4 weeks, not 4 months, but it's just out. And 4 weeks. And it's quite humbling being a student of Warren Buffett, having written about him now for 25 years, to admit, as I did in the book, that I overlooked, I think, what is probably one of the most important parts of being a successful investor, as Warren has taught us, and that's about temperament. At the 2017 annual meeting that he introduced a term that had never been heard before called a money mind, and began to explain that the next person who sits in the CEO chair at Berkshire Hathaway must possess a money mind. And it was at that moment, sitting in the annual meeting, that I said to myself, you've spent the last 25 years working on methods, the mechanics, how Warren Buffett invests. You really have discounted what I came to believe was the most important part, which is temperament. And when we finished the book, it really became evident to me, Andy, that investing is really two distinct buckets. It is a philosophical bucket, a thinking bucket, that then connects to the method bucket, the investing bucket. And you can't be successful in your methods if you're not anchored well to the philosophical side. And the book is a thinking book, not a method book. And we really went back to the beginning and said, okay, how should we best think about the formation of this money mind that is Warren Buffett? And we began with his dad, Howard Buffett, who was a great libertarian, raised on Emersonian philosophy, all the way through Ben Graham, Charlie Munger, through rationalism and pragmatism, and gave examples of how that's worked throughout his entire career. So it was really fascinating and both humbling that it took me 25 years to figure this part out. But I think it's a critical variable that makes what Warren does successful is combining the philosophical with the methods. Both of them working in tandem is what's made it.
Thank you, Robert. Carol, I don't know if you've had a chance to look at this new book, Robert's new book, but something in it reminded me of you a little bit, because he talks about a book that Buffett read when he was a small boy called 1,000 Ways to Make $1,000, and it was written by a woman who used the name F.C. Miniker, because back then I guess it wasn't really accepted for a woman to be writing about money. She used her initials. Does that story sound familiar to you, Carol?
I do know that story. I think I put it into Fortune a long time ago. And if there was ever a kid who was ready to accept the gospel about making money, it was Warren. And so he leaped all over that book. I didn't know about the woman, so I can't explain that. I do want to mention one thing that really hasn't come up about Warren today and is so important in what he's like. His sense of humor is just one of the best senses of humor I've ever seen. His instinctive wish, if he is talking to you, is to say something funny after what you have said. And he so often carries that off and makes that happen. And I think that any biography of Warren ought to be very clear about his sense of humor.
I think that's a really important point, and people ask me what he's like sometimes, and I know you've said this too, Carol. He's very, very funny. He's really one of the funniest people I've ever met.
That's exactly right. He really is.
He has a great sense of humor. And again, just comfortable in his own skin and able to relate to people and talk to people. It's just pretty extraordinary. I want to switch over and talk a little bit about something also near and dear to Carol's heart, which is the annual letter, and which Carol has been editing for, I don't know how many years. How many years have you been editing the letter, Carol?
I actually think it's 50. I'd have to count up, but I think it's around 50.
Happy anniversary. Is that right? This will be the 50th year?
Well, no, it's someplace in the 40 or 50 years. Who's counting, at my age?
Who's counting when you're having fun? Anyway, what an incredible run that has been. And obviously it is huge news when it comes out, and people read every word very carefully. I know it comes out Saturday morning, and we have a whole team of people poised at our computers ready to just pour through it as fast as we can. So I guess I want to go around and ask the panel. I know all of you have read it, especially Carol, several times. But I want to go around and ask you guys what your main takeaway from this year's letter is. And Tom, maybe I can start with you. And I think that sort of speaks to maybe the current status of Berkshire and where things are right now to a degree as well.
Sure. Well, I think one of the main points that I took away from this year's letter, and this has really been happening over the last couple of years, is Berkshire as a company has changed over the years. And that's reflective of both Buffett and Munger's skill. It's reflective of the size and scale of the business today as compared to what it was when they first started. It's reflective of the fact that the world has changed and economies and markets are different than what they used to be. So, for instance, in the early days of Berkshire, it really was the Buffett Investment Partnership and his investment skills. And he ended up with a textile mill, which then, he used his reinvestment skill to morph it into a different business. So his skill at managing investments in publicly traded securities was the defining feature of Berkshire for one era. Well, then once you bought National Indemnity, Berkshire came to be thought of as an insurance company along with Buffett's investment acumen. And to some degree, it might have been a horse race between those two pistons in the cylinders of the engine about which was the defining feature of Berkshire. And the letter was just describing the painting as it was being painted all the way along. In the most recent 5 and 10 years, with the purchase of Burlington Northern, with the purchase of the utility assets, it has morphed from a pure sense of what Buffett's investment skills were and what an insurance company does and how it reports its results to a conglomerate and an enterprise and a vastly bigger, larger, multifaceted organization than what it used to be. And part of the brilliance of this year's letter in particular is that in the very first paragraphs, Buffett tells you a pretty good guide for how to think about the business. So look at the operating income. Look at the earnings from the businesses that are part of Berkshire Hathaway. Look at the sense of look-through earnings from the investment portfolio, how the share repurchases at Apple benefit a Berkshire shareholder. So I think it's just masterful in the way that bit by bit by bit, if you want to know what you own as a shareholder of Berkshire Hathaway, what that is compared to what it was a year ago and 3 years ago and 5 years ago and 10 years ago, he's given you the guide, and people overcomplicate it. The simplicity that a genius can really bring to the table, I think came through right away in the first few paragraphs of the letter.
See, I knew all you guys read it, especially Tom and Larry. I want to ask you. I mean, so there's a number of things, and Tom mentioned the conglomerates. The good conglomerates are different from other conglomerates. There's share buybacks, all kinds of other topics. What struck you?
The extensive discussion of his favorite shareholders. His favorite shareholders at Berkshire are the millions of individual long-term owners, the true partners. He said there are 5 buckets of shareholders, or starting with his. They're institutional shareholders. Many of them are indexers who just have to own the stock, so they haven't picked the stock. He doesn't have any particular affection for them. There are institutions who may be long-term, maybe short-term. He cares about them and probably favors the long-term holders. But he said he has a special kinship, he and Charlie both, for the individual shareholder who's chosen Berkshire and who intend to hold it for a long time. And that he began consciously cultivating back in 1978 when he started this. And he succeeded like no other company. Even Markel doesn't have the percentage of individual shareholders in the shareholder base that Berkshire has. And he spent several paragraphs this year extolling that cohort and explaining why they're so important to him, and it connects directly to Tom's point about the sense of partnership. It's easy to feel a partnership with families and friends in a way that it's a lot harder with the trillion-dollar indexers. Can I say one thing more also, Tom, about Charlie, since he's come up a few times and including in that poll where 48% of the listeners said, yeah, that's something I rank highly at the meeting. His laconic comments, his iconoclastic style, even if it is, I have nothing to add. He's a man of, he's, if you're at a talk, I'll say more than he needs to. And his most famous, most valuable word is no. Warren used to call him the abominable no man because he checks, right? He checks Warren when any investment has some risk with it, and there's more and less risk, and any individual can make a mistake. And Warren has been smart to choose Charlie as his number 2 because Charlie is also very good at investing, and on many occasions, Charlie has saved Berkshire billions of dollars by telling Warren, I don't think we should do that. And Warren brags about this often. And then there have been some times when Charlie said no, and Warren did it anyway. The most famous example of that was the acquisition of Gen Ray, which it was what Warren considered to be a mistake afterwards because it had a hidden book of derivatives that blew up and were very costly. It took years to unwind. Warren went in thinking I can fix those problems. Charlie said, I don't think you can, and I don't think we should do it. So Warren said, look, there's a mistake of commission I made because I didn't listen to Charlie. But he said, thank God for most of the times I haven't done things that Charlie has said not to. And I think the lesson, certainly for corporate America, but I think in all of our lives, is it's very important to have a number 2, a reliable partner whose judgment you trust, whose intellect is superb, and who can just, when you're about to make a decision, run it by them. Most of the time you'll get the green light, but you can save a lot of money and anxiety by listening to them. And so that's part of the duo. That's, I think, part of the secret sauce is that the 2 of them working in that very special way together.
Yeah, an incredible partnership. And I know Buffett says they've never gotten in any arguments. And on the one hand, they're alike, but on the other hand, they are different. To your point, Larry, they're very complementary. So there's both of those things. I want to get back a little bit, though, to the letter this year, because we haven't heard from Robert yet, to hear what your big takeaways are.
Well, I certainly agree with Larry and Tom's observations. For me, though, personally, investor that helps financial advisors and clients, the big takeaway was the comments about the bond market. I think he said, that he thought bonds faced a bleak future. That's probably a very polite way of saying bonds are going to be a terrible investment for people going forward. And when you begin to kind of get your hands around that, bonds represent for insurance companies, endowments, foundations, and particularly for retirees, maybe the majority of their investments. And Warren is basically saying to you, this is not going to work out well for you in the future. You're thinking about pivoting away from something that's been a core holding for you for decades and decades and decades, since the 1980s, the bull market, 82, and the bull market bonds, that things are going to be different, and you need to think about it differently. That was my big takeaway. I think it's telling when Berkshire Hathaway, and it's a unique structure, but world's largest insurance company, has $113 billion in T-bills and only $3.4 billion in long-term debt. So if you take it prima facie, he doesn't have any money, hardly, to speak of in long-term debt. That's something important. And so I think investors have to really think that even though bonds have represented a core holding for them, and they still represent a good part of their portfolio, but not a majority of the portfolio anymore. That's just not going to work out well for investors. So for me, that was a big tell. And I think people really need to take that advice internally and think about how to reallocate assets in order to meet their long-term. And as a side note, I don't know if it's the right call or not, but Verizon and Chevron, when I first saw those investments, I kind of thought about it and said, well, that's interesting. And then it occurred to me that basically what these may be are bond surrogates. When you look at the yields of Verizon, you look at the yields of Chevron at 4 to 5%. That's a pretty good return. And it shouldn't be lost on anybody that the best performing asset this year are dividend-paying stocks that people are clamoring for over bonds, which are not where you want to be in the years to come. So that was my takeaway.
Thank you. Yeah, that's an interesting point about Chevron and Verizon. I should note Verizon is Yahoo's parent company, full disclosure there. Carol, I want to go over to you and ask you about the letter and editing, and you got to tell us some behind-the-scenes stuff here. What was it like with this year's letter? Were there any stories? Were there any points of contention? Or how does it just generally work, maybe is a better question, between the two of you?
Well, I think that's the easier for me, certainly, to start with. First of all, Warren writes the letter, and he says, and I believe him, that he starts writing next year's letter when this annual report goes out. And it's no easy task because he doesn't like repeating himself, and so he's always looking for fresh subjects to bring to the letter. And so maybe around October, I get a first draft of the letter. And then I start weighing in with suggestions about what editors do, like clarity and maybe you should move this sentence down here and that kind of thing. And then I send it back in the mail, because if we talk on the phone about it, we're both likely to get angry. So that's the inside, that we communicate by sending drafts back and forth, and they gradually get worked out. And it's a long process. It's a hard process for both him and me. But at the end, a letter comes out that Warren has written, and it does reflect the subjects that he felt most strongly about getting before the shareholders. And I thought that the discussion of the longtime shareholders was very, very good and very important in thinking about Berkshire. Does that satisfy you, Andy, or do you want more?
I always want more dirt here, but I didn't realize that. Well, I guess I knew that it took months, and I didn't realize that you guys were so passionate about it. You were concerned about knocking heads and communicated that way. That's very interesting. But I can, knowing both of you, I can see that you're strong-willed people with great insight and some strong opinions as well. So, but the relationship seems to work pretty darn well.
Well, it does, and I must say, Andy, you and I worked in a system at Fortune where the editor had the ultimate responsibility for what was said. And I really don't have the ultimate responsibility for what is said. Warren and I can argue over points, but in the end, it's his letter. So,
right. Hey, Carol, while I've got you here, I want to ask you to tell the story about how you met Warren Buffett with your late husband, John, and how that transpired.
Well, I think we're talking about 1967, and my late husband was always worked in Wall Street, and he worked as a salesman covering institutional accounts. And one time he read a small item in Business Week about this man, Warren Buffett, whom he'd never heard of in Omaha. And he wrote Warren a letter and said he was going to be in Omaha the next Monday. And could he drop in and see Warren? And it has always amazed me that Warren saw him, because Warren didn't talk much to security salesmen. So here was this guy who was going to take up his time, but he did, and they liked each other. And Warren said, let's go over to the hotel and have lunch. And then about a month later, Warren and his wife, his first wife, Susie, asked us to have lunch, asked Warren, asked John and me to have lunch. And we all four met. And I'm sure that he was interested in the fact that Warren was interested in the fact that I wrote for Fortune. He has said that if he hadn't been an investor, he might have become a journalist. And he has always had a great interest in journalism. So that is how we met, and we became friends. And then in time, Warren asked me if I would take on the editing of his letter. So it was a long history.
Wow, I think it's almost 55 years ago. If it's back to 67, that's
right.
Pretty amazing. Pretty amazing.
Yeah.
Tom, can I share a story on a theme of that sort?
Sure.
I met Carol in 1997, same year I met Warren, and I did a conference at my school. They both attended on the letters. It was one of the coolest things. Carol, about 200 people in an audience with 30 critics examining every part of the letter. Susie was there, Warren, Carl, Ajit Jain, Lou Simpson, Charlie, obviously. Charlie chaired one of the panels. It was a spectacular intellectual fun. We got the thing done, and this had gotten some press coverage, and so book publishers were very interested in the content of what we had done. We rearranged the letters, including a person who's become a very good friend, Miles Thompson, who's also Robert's publisher. He was at Wiley at the time, and he was very eager to get the book and was trying to encourage me to do it and to ask Warren to see if I could publish this book. And he said, and Miles said, the content here, what Warren has created here, it's the equivalent, the intellectual equivalent of the Wealth of Nations. So I reached out to Warren. One of the other great things about Warren, besides his humor, is he was, at least historically, he responds to correspondence. So I've written him a letter. He called me up and said, tell me about this publisher. What do they want to do? And I told him it was Wiley, and they think the book could be as important as the Wealth of Nations, and so they're very eager to publish it. And he said, well, that's interesting, Larry. I don't mind it being the Wealth of Nations, but I don't want it to be the Wealth of Wiley. This book will sell on its own. He said, so if you want to publish it yourself, feel free, but that's up to you. And so I've self-published the collection, the Essays of Warren Buffett, ever since with his blessing. And he was absolutely right. It's been just a wonderful opportunity to disseminate that wonderful set of ideas that Carol continues to have so much to do with.
Yeah, that's a great story, and that speaks again to his sense of humor and also to his generosity. I mean, Buffett is, really great about, spending time and giving his time to people, which is pretty amazing. I want to look at the results of the poll. Let's see here, and this one is: what aspect of Berkshire culture is most distinctive? Trust-based. Let's see, we got that. Oh, here it is coming up. Trust-based, 27%. Decentralized autonomous managers, 16%. Permanence, long-time horizon, 46%. Quality shareholders, 11%. So again, here's one where almost half of the people on the webinar say that one answer, which is to say permanence and long-time horizon is the most important or the most distinctive aspect of Berkshire culture, which I think makes a heck of a lot of sense. So I think we want to talk now about a little bit about expectations, great expectations, and the expectations for the Q&A this year. What kinds of topics are going to be discussed and what kinds of questions are going to be asked. And I think I will start with Robert and ask you that question, the question about questions.
It's always about the allocation of capital. So where are we going to put our money? Where does the money go? And he gave us, good ideas in the annual report that a lot of money is heading to Berkshire Energy and Burlington Northern. And that's good because they're large depositories that can assume a lot of capital. They can put a lot of capital to work. So there had been a problem in the past when he built up so much capital. What do I do with the capital? Now he has an investment opportunity that'll generate good returns, not great returns, but good returns. But I think this year will be unique because Ajit will be there. And obviously the insurance business, the National Indemnity, and all that he has accomplished with his lieutenants there has just been phenomenal. And you've read Carol has written about it, and Larry's talked about it. Tom knows so well, being at Markel, that if you've got a good insurance guy that understands risk and can price it properly, you can make a lot of money. And Warren has certainly tipped his hat to Ajit over the years about how much money Ajit has made. So now we get a chance. And I hope that Ajit gets a lot of bandwidth to talk about the nature of insurance, the nature of reinsurance, the pricing, and the opportunity. That's going to be a big deal this year.
Great. Tom, what about you?
Well, I don't know. It's been funny to observe over the years. There generally speaking is a theme of questions that almost accuses Buffett of having lost touch. So in various episodes in financial markets, there's times when again, getting back to Shad's line about looking dumber than you really are, we've all been around long enough to have seen those kinds of times at Berkshire. So it tends not to be so much as a question, but hey, Warren, have you thought about fill in the blank of whatever's going on? So I rather suspect whether it's Bitcoin or SPACs or some of the things that are happening in financial markets, there'll be some questions about that. I think the more serious and thoughtful questions will be structurally, how do you keep Berkshire going forward after you're no longer here? And Larry wrote a great book among the things he's done about Berkshire after Buffett that really tries to address the question of systemization. And one of the things that I look at and I think about in the context of Berkshire is when I'm looking at businesses, I think about, well, what businesses have survived and thrived past the genius founder? And I grew up in the Delaware Valley, and the model of the DuPont company is heavy in my mind because there was a company that really kept it going for a couple of 100 years after the founders of that business had passed. So their mastery of the reinvestment challenge, which they embraced through the technology of the day, Lewis chemistry and better living through chemistry, that list of companies that have managed to do that for generations past the founders is really thin. It's really thin. And I would describe it in many ways as the number one challenge for a Berkshire shareholder today to think about the next 50 and 100 years. I agree that they've systemically done everything that they know how to do to make that as good as possible, but that's front and center in my mind.
Okay, that's great. Yeah, the Delaware DuPont situation is really pretty amazing. Carol, I want to go over to you with the question, but I want to ask it with a wrinkle, which is, and it's something near and dear to my heart, which is you get to ask, or customarily, the first question. And boy, it's kind of like you get to ask the first most important question to Warren Buffett every year. What an amazing spot that is. Is that how you think about it? And I know you're not going to tell us what your question is. Right? I'm not going to even bother to ask you. But how do you decide? What's the decision process that you go through when you try to figure out what to ask them first?
Well, I think sometimes the decision almost forces itself upon you because there's been some subject that has consumed a lot of attention, and you know that if you don't ask it as the first questioner, then those other two reporters behind you are going to kind of say, what is she doing? She's laying off of the big subject. So you really can't do that. And so there have been occasions when there was a big subject, and like if you go back when David Sokol was working for the company, then that became a big subject. And then there are other times that it isn't as obvious, and you have to pick out what you think is most interesting. Now, today, I don't know whether everybody knows this or not, but there was a competitive move in energy where Barry Sternlicht's company, Starwood Energy, is competing for the same business that Berkshire is trying to get in Texas in the wake of the terrible trouble that Texas had with energy, and that's very interesting to have two big companies and to have somebody competing as openly with Berkshire. And then I'd like to know what about that those Japanese trading companies that he bought stakes in. What about them? And then I think there may be still some companies, some shareholders who are interested why Amazon and Berkshire and Chase Bank dropped out of the health business. Very interesting situation.
Wow, it sounds like you're almost tipping your hand here, Carol.
Well, I'm not going to be asking the questions. That's why I'm tipping my hand.
Oh, that's true. That's true. Ah, yes, of course. That explains that. Okay, we're going to go probably for the remainder of the time here because we've got so many great questions. We're going to go to the audience questions, which are, like I said, some really, really good nuggets here. And let me take one here from Gregory, who asks, it looks like a monumental shift from merely owning business to owning stock, Apple being such a large example. Is this a good thing or a symptom of there not being large businesses to buy? Larry, do you want to take that one on? So in other words, it looks like instead of just buying companies outright, that Berkshire is taking these stakes instead. I don't really know if it's accurate, but is it intentional? And what does that say?
Well, thanks for the question. Warren has always described their approach to investments as the double-barreled approach, which is they're happy to own 100% of a company or a small part of a company simply based upon what opportunity set is available for them to deploy their capital. And it just so happened for the first 20 or 25 years, most of the opportunities were in publicly traded securities. So through 1997, 80% of the asset base was in marketable securities and 20% was in operating companies. In the 20 ensuing years, that percentage flipped around so that today 80% of the assets are in operating businesses and 20% are in securities. And so I don't think there's any sort of decision that says, well, let's buy more stock and less operating companies. I think that is the opportunity set. I guess that the question included that as a supposition. It's hard to find attractively priced elephants. There are many reasons. Oceans of capital and armies of private equity are pushing acquisition prices up very high. So it just might be that the phone for the elephants isn't ringing like it used to. But Apple was an appealing investment opportunity. So it's hard. I wouldn't extrapolate from this that you're to expect more of this or less of that. I think the double barrel approach remains the approach, and it'll be used opportunistically.
Robert, why don't I get the next one over to you? This one comes from Ben. Why did Buffett wait so long to begin buying back shares in meaningful amounts?
Well, he's always, explained the process is that there had been an adequate discount between the intrinsic value and the stock price. Modest discount, may not have been appetizing enough to allocate the capital. Quite frankly, I'm glad that he didn't, buy back a lot of stock. Instead, spent $36 billion on Apple, which made us $100 billion in profit thus far. So it's about the opportunity set in front of you. Where can you allocate capital for the best return? Berkshire has not, in my opinion, been at a huge discount to underlying intrinsic value. Modest, as Warren says, modest discounts to intrinsic value, and he did put some money to work, this past year up to about $25 billion. And so that was good and increased the share price, the individual share ownerships of each of us that own Berkshire Hathaway. But I think the whole idea about buying Berkshire at a discount is only going to, buying a lot of stock at a discount will only be made possible if there's a significant price differential between the intrinsic value of the stock price. Without that, he has to go look for investments. And then I'll just key off on one thing earlier, Andy, about, do you buy common stocks, do you buy businesses? We swapped emails earlier in the week about different ideas, and Carol said, don't forget, buying a stock is buying a business. And I think in Warren's mind, there's no difference between buying Apple or buying an individual business. Just because one is a partial ownership in a common stock and the other one he gets 100% of it. In his mind, he owns businesses, whether they are common stocks or wholly owned businesses. So there's no differential. He's just allocating capital where the best opportunities are.
Great. Tom, let me ask you, it's kind of a related question from Martin, who wants to know, do you anticipate Berkshire using their significant cash balance to make a major acquisition in the near future, or is it more likely that share repurchases will be continued and possibly ramped up?
I think the answer is all of those things are possibilities on the table, as they have been for decades now. And that's really the beauty of Berkshire, is there's a 360-degree range of what they can allocate capital to. So, again, I think one of the things that's underappreciated about Buffett and Munger, think about an Olympic dive competition. Well, not only are you judged on how well you execute the dive, you're judged on how hard the dive you're executing is. So there's a degree of difficulty assumed. The fact that Berkshire has retained the bulk of its capital for year after year after year after year and changed and adapted, that's an extraordinarily hard dive to do. And I think a lot of people of lesser skill and with different incentives and different channels would have done share repurchases a lot earlier, but they don't have the skills that Buffett and Munger had. So as a shareholder, I'm grateful for the way in which they've done that. There is the challenge of scale these days, and things are so big that it is hard to find big pools of places to put capital. But I think in their heart of hearts, they were able to buy something that they thought could compound into the future. They would rather do that than repurchase shares. And I applaud their ability to have done so for so long. And I don't think any one of those features of Berkshire is over yet.
Carol, I want to ask you if you have any insight into how the investing process has changed over the years with Warren and with Charlie, and especially now with Ted and Todd very much in the picture. Is the process different now than it was, say, 10 or 15 years ago?
Well, I do think that on the face of it is different, because it was only Warren making the decisions if you go back. And then Todd and Ted stepped into the picture. And what that has done for people looking on is to muddy the waters as to actually who is buying the stock. If Berkshire doesn't announce, but reveals that it has bought a stake in a new stock, and it's a moderate amount, you don't really know whether it's Warren or Ted or Todd who made the purchase. And that certainly is different. If it's a very large amount that's gone into a stock, it's almost inevitably Warren who has done it, because the other two guys don't have that much money to invest. So I do think it's different, but I still think that it's Warren there at the helm. They have a lunch, I think, every Tuesday, or that used to be the case, and I'm sure that they talk, and I'm sure that they gain wisdom from the other two who are listening.
Great. Thank you, Carol. This is an anonymous question, but it's okay. And the question is, should there be a reason for concern for shareholders looking to own the stock beyond Buffett and Munger, I guess, after they're no longer running the company? And what will be the telltale signs of decline at Berkshire? And why don't we give that one to go back to Larry?
Well, as I suggested earlier, I think that the company has done everything reasonably possible to ensure its longevity and prosperity beyond Warren and Charlie. That includes, first of all, they've got 65 different businesses that are all part of the culture. The leadership understands the culture of permanence, of autonomy, of trust, of playing in the center of the field. So there's a huge 400,000 employees who are playing the game that way. Millions of shareholders who get that, appreciate that, and want it. And the board of directors understands this. The successor at chairman is to be Howard Buffett, who has this obviously in his genes. It's likely that Todd and Ted will continue in the investment function. Ajit and Greg will continue in the executive leadership function. And so I think that they've done everything reasonably possible. I think that the telltale signs, I mean, if they're not able to deploy capital at high rates, at better than, say, an index, some shareholders will begin to lose their loyalty and lose their patience. And so if they're unable to outperform, then the shareholders will get restless, and you'll see some potential unraveling. You'll see activists enter and clamor for a dividend and clamor for selling off divisions. And it will be, as I said earlier, up to the shareholders ultimately, after Warren's stock is distributed out to the market over 12 years, it'll be up to that cohort. So I'm holding my stock. I don't have any plans to sell it. I think they've done everything they can to continue this distinctive organization. And I think, in my opinion, that's Warren's singular achievement, is that he's created an organization that's larger than himself.
Great. That brings us to the conclusion of this webinar. I think that's just been incredibly terrific insight from you guys. So I want to thank everyone on the panel so much. Robert Hagstrom, Tom Gayner, Larry Cunningham, and my colleague, Carol Loomis, my former colleague. Thank you guys so much. Of course, this is Berkshire Hathaway week for all of us on the call. It's kind of a celebratory week and a week to learn more about Berkshire and talk more about it. Thank you for watching. I'm Andy Serwer, Editor-in-Chief of Yahoo Finance, and we'll see you Saturday, May 1st at the Berkshire Hathaway Annual Shareholders Livestream here on Yahoo Finance.